The mat hold candlestick pattern is a valuable tool in identifying potential continuations within bullish trends. This pattern typically forms during a prevailing uptrend and begins with a strong bullish candlestick, followed by several smaller, mostly bearish candlesticks. These smaller candles signal brief pauses or minor profit taking in the market, without challenging the underlying bullish sentiment. The pattern is completed with another strong bullish candlestick, confirming the continuation of the uptrend. For those analyzing the markets, it is crucial to practice identifying and interpreting the mat hold pattern within various market conditions. This practice will refine your analytical skills and help you adapt to market changes more effectively. Recognizing this pattern and understanding its implications can be a stepping stone to making more informed investment decisions. In conclusion, mastering the use of candlestick patterns like the mat hold requires patience, diligence, and disciplined risk management. The journey to becoming proficient in candlestick pattern trading is not one of overnight success, but of continuous learning and adaptation. The insights gained from these patterns can significantly enhance your market analysis, providing a clearer lens through which to view potential market movements. Remember, the key to success lies in consistent practice, ongoing education, and a well-calibrated approach to risk management. Candlestick patterns are essential tools in financial analysis, giving investors insights into market conditions and potential price movements. Each candlestick represents a period of trading and includes data points such as the opening and closing price, as well as the high and low price during that period. The visual representation of these candlesticks helps analysts to understand market dynamics and investor sentiment at a glance. Rare and complex patterns go a step further by providing unique insights that are not frequently encountered in the market. These patterns, due to their intricacy and the conditions under which they form, can sometimes offer significant indications about future market movements. Although they occur less often, the insights gained from correctly interpreting such patterns can be quite valuable. For example, a rare pattern might signal a major reversal or continuation of trends, allowing informed investors to adjust their strategies accordingly. Understanding these patterns requires a mix of experience and knowledge of market mechanics. When identified and interpreted accurately, both common and rare candlestick patterns can be powerful tools in a trader's arsenal, aiding in the decision-making process by offering clues about potential market directions. Rare and complex candlestick patterns in the financial market are those formations that occur less frequently and entail a greater number of conditions than the more common patterns. These patterns are formed by a specific sequence of candlesticks, each representing price movements within a given time frame. Unlike simple and commonly observed patterns such as the doji or hammer, rare and complex patterns provide deeper insights into market sentiment and potential reversal or continuation signals. However, they require a more nuanced understanding of market dynamics. One example of a rare and complex pattern is the abandoned baby. This pattern consists of 3 candlesticks and signals a potential reversal. It is characterized by a small body candle, referred to as the baby, that gaps away from the preceding long body candle and the following long body candle in the opposite direction. The first and third candlesticks are of opposite colors, depicting a shift in market sentiment. Another intricate pattern is the stick sandwich, which occurs over 3 days. This pattern consists of 2 long black or red candlesticks with a white or green candlestick sandwiched between them. The closing prices of the two black candles are nearly equal, and the white candlestick represents a temporary interruption of the prevailing downtrend, which might suggest a bullish reversal. The kicking pattern is noted by its opening gaps. It consists of two Marubaju candlesticks of opposite colors. The first candlestick opens and moves in one direction, but the next session gaps open in the opposite direction and continues to move away from the first day's close. This pattern indicates a strong and sudden shift in market sentiment. Imagine watching these patterns unfold. The abandoned baby leaves a solitary candle gap away from others, likening to an abandoned child. The stick sandwich visually interrupts a downtrend with a surprising move upwards, offering a glimmer of hope to those watching for a reversal. The kicking pattern, on the other hand, resembles a swift and decisive change in direction, similar to the action its name suggests. Understanding these rare and complex patterns requires careful observation of market movements and a keen sense of timing to discern their potential implications on future price actions. They represent nuanced shifts in market dynamics that, when interpreted correctly, can offer valuable insights to those able to spot and analyze them within the broader context of market activity. Rare and complex patterns within a market trend can significantly impact financial analysis and investment strategies. These patterns are diverse in shape, size, color, and typical position, yet they all share the commonality of offering strategic insights into future market movements, whether indicating potential reversals or continuations of trends. Shapes of these patterns may vary greatly, including but not limited to head and shoulders, double tops and bottoms, and cup and handle formations. Each shape has its own predictive value and implications. For instance, the head and shoulders pattern often signals a reversal of a current trend. The size of the pattern also matters, with larger formations typically indicating stronger and longer-lasting effects on market trends. The color, often seen in the context of candlestick charts, can suggest momentum. For example, a series of red candlesticks might indicate a downward trend, whereas green ones suggest upward momentum. Typically positioned at critical points within market trends, these patterns can offer insights at the cusp of changes, whether at the peak of uptrends or the troughs of downtrends. Recognizing these patterns within the correct market context is vital, as it unveils opportunities for strategic decision-making. Identifying a pattern early in its formation can allow for predicting reversals or continuations with greater accuracy, providing investors with a competitive edge. The significance of recognizing these patterns lies in their ability to signal key market movements ahead of time. An understanding of rare and complex patterns equips investors with the knowledge to make informed decisions, potentially leading to optimized investment strategies and enhanced portfolio performance. Through careful analysis and recognition of these intricate market signals, investors can better navigate the complexities of financial markets. Rare and complex patterns in the financial markets are significant indicators of market sentiment and the psychology of traders. These patterns, due to their scarcity, often signal significant turning points or provide confirmation of the strength of existing trends. When traders identify these rare patterns, they are glimpsing into the collective mindset of market participants, where fear, greed, and speculation converge to drive market prices. The emergence of a rare pattern can act as a catalyst for trader decisions, influencing market movements in profound ways. For instance, a rare bullish pattern might prompt traders to enter long positions, anticipating an upward move in prices. Conversely, a rare bearish pattern could lead to selling off assets, expecting a downturn. The psychological impact of recognizing these patterns cannot be overstated. They often lead to a herd mentality where traders collectively move in one direction based on the perceived significance of the pattern. Moreover, rare patterns contribute to market movements by altering liquidity. As traders act on these patterns, buying or selling pressure increases, which can lead to significant price movements. This self-fulfilling prophecy, where patterns lead to actions that reinforce the expected outcome, underscores the intricate link between market sentiment, trader psychology, and market dynamics. Ultimately, understanding and interpreting these rare and complex patterns require a nuanced grasp of both technical analysis and market psychology. Traders who can accurately identify and act on these patterns often position themselves advantageously in the market, capitalizing on shifts in sentiment and market dynamics before they become apparent to the broader market. In the world of technical analysis, rare and complex patterns in price movements can signal potential continuation of trends or mark the advent of reversals. These patterns, due to their infrequency, require a keen eye and understanding of market context for accurate interpretation. One such example of a rare pattern acting as a signal for continuation is the cup and handle formation. This pattern resembles a teacup in a chart where the price first experiences a drop and a rounding recovery, forming the cup, followed by a smaller pullback, forming the handle, before continuing on the previous uptrend. Historically, this pattern suggested a pause in the bullish market trend, offering investors a new entry point before the continuation of an uptrend. For instance, imagine a chart where the prices gracefully dip and rise, forming a smooth U shape, and then slightly retract before breaking upwards. This is the classic cup and handle, indicating an upward trend continuation. On the flip side, the head and shoulders pattern typically heralds a reversal. It features three peaks, of which the middle one, the head, is the highest and the two others, shoulders, are lower but at roughly the same level. This pattern often signals that an uptrend is nearing its end and a reversal is imminent. For example, envision a price chart where, following a strong uptrend, prices peak, left shoulder, recede, reach a higher peak, head, decline again, and rise to a lower peak, right shoulder, before sharply declining, symbolizing a shift to a downtrend. The diamond pattern is another sophisticated formation that can signal either a bullish or bearish reversal, depending on its position in the trend. When it appears at the peak of an upward trend, it acts as a bearish reversal signal, indicating that prices might plummet. Conversely, when it emerges at the bottom of a downtrend, it predicts a bullish reversal, suggesting an upcoming rise in prices. Understanding the market context surrounding these patterns is critical for accurate interpretation. Factors such as volume, historical price levels, and overall market sentiment provide essential clues. For instance, a cup and handle pattern accompanied by increasing volume as the price breaks out of the handle offers a stronger confirmation of trend continuation compared to the same pattern occurring on low volume. Rare and complex patterns require a comprehensive understanding of both the formations themselves and the broader market scenario. Traders and analysts examine past occurrences of these patterns on charts, matching them with surrounding market conditions to forecast future price movements. By blending pattern recognition with market context, analysts can more accurately predict whether a rare pattern signals a continuation of the current trend or a pivotal reversal, guiding investment strategies accordingly. To understand the predictive power of rare and complex patterns in financial markets, it is essential to consider additional indicators such as trading volume, the strength of the preceding trend, and the subsequent price action following the pattern formation. Trading volume serves as a key indicator. A significant change in volume provides validation for the pattern. For instance, an increase in trading volume during the formation of a pattern suggests strong investor interest, which can reinforce the reliability of the pattern. Conversely, low volume may indicate weak support for the price movement, signaling caution to investors. The strength of the preceding trend is equally important. Patterns that form after a strong trend are often considered more reliable. This is because they represent a true shift in market sentiment. A pattern emerging from a weak or inconsistent trend might not carry the same predictive strength and should be approached with caution. Finally, the price action following the pattern's formation offers valuable insights. A clear and decisive move in the expected direction following the pattern's completion further confirms its predictive power. If the price action is hesitant or moves in the opposite direction, it may suggest that the pattern was false, urging investors to reevaluate their positions. Together, these elements enhance the analysis of rare and complex patterns by offering a more nuanced view of market behavior. By paying attention to these indicators, investors can better assess the reliability of these patterns and make more informed decisions. The historical reliability of rare and complex patterns in predicting market movements has shown a mix of successes and limitations. These patterns, known for their infrequency and intricate formations, often signal significant market shifts, drawing the attention of investors and traders who seek to anticipate market trends. One of the successes attributed to these patterns is their ability to pinpoint potential reversals or continuations in the market. When identified correctly, rare patterns like the head and shoulders or cup and handle can offer a strategic advantage by suggesting upcoming price movements, thereby aiding investors in making informed decisions. However, the limitations of relying solely on these patterns are notable. Due to their rarity, the occurrence of these patterns can often lead to false signals or misinterpretation by investors, especially those without extensive experience or expertise in technical analysis. The complexity of these patterns also means that by the time they are fully formed and recognized, it might be too late to capitalize on the anticipated market movement. This underscores the necessity of corroborating signals from rare and complex patterns with other forms of technical analysis. Incorporating additional indicators such as moving averages, volume analysis, and momentum oscillators can enhance decision-making confidence. For example, a rare pattern suggesting a bullish reversal when combined with a rising moving average and high trading volume can offer a more compelling case for an upward market move. In essence, while rare and complex patterns hold valuable insights into potential market movements, they are most effective when used as part of a broader technical analysis strategy. This approach enables investors to validate their predictions and navigate the financial markets with greater assurance. To develop a nuanced trading strategy, integrating rare and complex patterns with widely used technical analysis tools such as the Relative Strength Index RSI, moving average convergence, divergence, MACD, or Fibonacci retracements can be immensely beneficial. These combinations can provide a more layered understanding of market movements and potential trading opportunities. For instance, a trader might identify a rare pattern called a cup with handle, which typically indicates a bullish continuation signal. To validate this signal, the trader could use the RSI to check if the asset is not in an overbought condition, ensuring that there is room for upward movement. They might also look at the MACD to seek confirmation through a bullish crossover, where the MACD line crosses above the signal line, reinforcing the potential for a bullish move. Additionally, integrating Fibonacci retracements could help identify potential levels of support and resistance within the pattern formation, giving more precise entry and exit points. A successful integration example could involve a trader spotting an Eve and Adam double bottom pattern, suggesting a potential bullish reversal. To enhance this insight, the trader might use the RSI to gauge the momentum and confirm that the asset is moving from an oversold condition towards a neutral or overbought zone, indicating increasing buying interest. Adding the MACD into the mix, the trader would look for a bullish crossover to occur around the same time as the completion of the pattern, providing further confirmation of a trend reversal. Finally, employing Fibonacci retracements from the initial high point to the bottom of the Eve trough could help delineate key levels where the price might encounter support or resistance on its upward journey, guiding the trader on where to set their targets and stops. Through these integrations, not only does the trader gain confirmation from multiple indicators, but they can also refine their strategy by identifying more precise entry and exit points, thus making more informed trading decisions. This approach marries the predictive powers of rare and complex patterns with the momentum and trend confirmation provided by RSI, MACD, and Fibonacci levels, creating a robust framework for identifying and capitalizing on trading opportunities in the market. When traders encounter rare and complex patterns in the market, interpreting and applying these patterns correctly can be challenging. A frequent error is the premature identification of a pattern before it is fully formed, leading to incorrect trading decisions. Traders might misinterpret the early stages of a pattern as a complete formation, not recognizing that these patterns often need more time to develop fully and provide clear signals. Another common mistake is overlooking the importance of pattern confirmation. For a rare pattern to be deemed reliable, it must be validated through additional market indicators or confirming price movements. Without this confirmation, the pattern's predictive value diminishes, and relying solely on incomplete or unconfirmed patterns can result in misguidance. Moreover, traders sometimes fail to integrate comprehensive analysis with the identification of rare patterns. This includes neglecting other aspects of technical analysis, such as volume analysis and momentum indicators, that can provide more context to the pattern's implications. The isolation of rare patterns without considering the broader market trends and indicators can lead to skewed interpretations. Lastly, a critical oversight is the inadequate application of risk management principles when utilizing rare patterns in trading strategies. Given the inherent complexity and, at times, the lower frequency of successful outcomes associated with these patterns, it is crucial to apply strict risk management techniques. This means setting appropriate stop losses, sizing positions correctly, and being ready to adjust strategies based on new market information. In summary, The accurate recognition and application of rare and complex patterns require patience, confirmation through additional market indicators, a comprehensive analysis incorporating other technical aspects, and stringent risk management practices. Emphasizing these elements when dealing with rare patterns can significantly enhance the trader's ability to use these sophisticated tools effectively within their trading strategy. To leverage rare and complex patterns in setting entry and exit points for trading, one must first become proficient in identifying these patterns. These patterns, due to their rarity, often signal significant market movements ahead. The strategy involves a few essential steps, including the recognition of the pattern, analysis of its potential impact, setting stop-loss orders appropriately, and determining realistic target objectives. When a rare pattern is identified, it is crucial to confirm its validity through additional market indicators. Confirmation could come from volume analysis, where an increase in trading volume accompanies the pattern, adding confidence to the predictive nature of the pattern. Setting entry points involves waiting for the pattern to fully form and often entering the trade on a breakout or breakdown from the pattern, depending on whether the expected market movement is upward or downward. Exit points are determined based on the historical performance of the pattern, allowing traders to set realistic target objectives for the trade. Stop-loss orders are a critical component of managing risk when trading rare patterns. These should be set at a level that is outside of the normal fluctuation range of the asset, but within an acceptable loss tolerance. The goal is to protect against the possibility that the pattern does not perform as expected. One anecdote that highlights the effective use of rare patterns involves a trader identifying a diamond bottom pattern in the stock of a technology company. This complex pattern, characterized by a broadening pattern followed by a narrowing price range, suggested a significant bullish reversal. The trader entered the position as the price broke above the upper boundary of the pattern, setting a stop loss just below the lowest point within the diamond pattern to manage risk. The target objective was set based on the height of the pattern projected upward from the breakout point. The stock price surged over the following weeks, and the trader exited the position near the target, securing a substantial profit. Such stories underscore the importance of patience, discipline, and rigorous analysis when trading rare and complex patterns. Traders who dedicate the time to understand and monitor these patterns can indeed capitalize on significant market opportunities. Understanding rare and complex patterns in the financial markets involves exploring variations and similar formations that can indicate different market implications. Here, we introduce known variations and relate them to their parent patterns, highlighting differences in formation and market implication. By doing so, traders can adapt their strategies based on these nuanced insights. One example of such a complex pattern is the head and shoulders and its variation, the inverse head and shoulders. The head and shoulders pattern is identified by three peaks, with the middle peak, the head being the highest and the two other peaks, shoulders being lower and roughly equal. This pattern signals a reversal of a bullish trend into a bearish trend. On the other hand, the inverse head and shoulders pattern is a mirror image of the head and shoulders, with three troughs instead of peaks, and the middle trough being the deepest. This signals a reversal of a bearish trend into a bullish trend. These patterns differ not only in their visual formation, but also in their market implications, highlighting potential buy or sell signals. Another important pattern is the cup and handle, which resembles the shape of a teacup on a chart. This pattern typically signals a continuation of a bullish trend. Its variation, the inverted cup and handle, mirrors the cup and handle but signals a bearish trend continuation instead. The difference between these two patterns lies in their formations, where the cup and handle forms after a bullish trend and suggests further bullish momentum following a brief period of consolidation, whereas the inverted cup and handle forms during a bearish trend and suggests continued downward movement after a brief consolidation. For traders and investors, understanding these patterns and their variations involves looking at chart examples to spot these formations. The distinct features of each pattern, such as the difference in peak and trough placements in the head and shoulders patterns or the shape of the cup and handle formations, provide signals for entry or exit points in trading. Adapting trading strategies accordingly involves not only recognizing these patterns, but also considering the context in which they form, including underlying market trends and volumes, to make informed decisions. In summary, recognizing rare and complex patterns and their variations is crucial for traders aiming to navigate the complexities of the market. By understanding how these patterns differ in formation and what they signal about future market movements, traders can refine their strategies to better capitalize on potential market movements.